Okay, let's get started. I'm Tucker Balch, and today I'm going to talk to you about an interesting approach we've developed at Lucena Research for discovering events that can be used in investing. Okay, we're going to cover what is an event, how to evaluate event definitions, how can we discover event definitions. We'll talk about manual approaches and also automatic approaches, and we'll look at some results. This upper line is the behavior of stock prices coming into an event. This lower line is the behavior of stock prices for negative news. The upper one is for good news, and this more or less horizontal one is no news. Again, this vertical blue line is the date the event occurred. So repeating again, as you can see, for good news, as we approach this event, prices tend to creep up, but then they jump up sharply. And similarly, for bad news, they jump down sharply. And then sort of as a control, he assessed what happens when there's no news. And as you can see, the price is flat in those cases. Now, within QuantDesk, this is what event studies look like. In fact, I'm going to go right now over to QuantDesk and show you some examples. So this is how we can, within QuantDesk, define an event. This is our QuantDesk platform, and along the top here are the various features you can select. We've selected events, and we're looking now at an event called Bollinger Bottom Short-Term Bullish. And you can see here, these are the factors that we consider. So we look at a factor called Bollinger Bottom, which indicates, for instance, that the stock price has hit the bottom line of a Bollinger Band. We also look at price change and something called fast stochastic. Now, if we like, within QuantDesk, we can edit that and change what these factors are. I'm going to skip doing that for a moment and show you what the event study looks like. So we looked for examples of this event between 2010 and 2014. And essentially what we looked at is every day we assessed those factors for every stock within our universe. And anytime all of those criteria were met, we said, boom, that's an event. So here are examples. For instance, Coca-Cola on January 11, 2010, an event was triggered, and then you can see what happened to the prices after that event. So you can see there's lots of green here, indicating that frequently stock prices went up. Now we can assess all these events for individual stocks together. First here by a heat map showing how it's distributed across different sectors, but also here in this chart, which shows, again, if you remember that vertical line from the McKinley study, that's the date of the event. We can see what happens on average to prices after that event. So remember, we were looking for instances where the stock hit a Bollinger Bottom, but also one of the criteria was that it was moving up. So you can see on average, our prices are going down. They hit that Bollinger Bottom, and then they begin to tick up. Well, what happens in the subsequent days? So this middle line here is average price over several days. And then these bordering lines, this represents one standard deviation. This is 1/2 of a standard deviation. You can move the cursor over there and see how much change happens on average. So in this case, we see about a 2.5% increase in price over 15 days. There were a total of 106 of these events over that time period. So that's what events look like within QuantDesk, and how you can craft them and evaluate them. Here's a example backtest of one of those events. Everything within QuantDesk you can backtest. You can see how they would have worked historically using our market simulator that is also uses survivor bias-free data. Okay, so those are what events are and how to define them. I'm going to take just a moment here. I see that there's a lot of questions, so I'm going to scroll through those. Okay, so recap. An event is defined as a set of factors and then thresholds for each of those factors. So for instance, an example event might be defined on the Bollinger technical factor, PE ratio, and Greenblatt rank. And then also thresholds for those factors. So if on a particular day, all of the thresholds for all those factors are met for a specific stock, boom, that's an event. And depending on whether it's a long event or a short event, we buy or short the stock on that day. So that's the definition of an event definition. We call these nuggets, and that's what leads to the name of our strategy, Gold Digger. So Gold Digger is essentially an automated method of trying to discover these nuggets. So I just showed you an example of an event within QuantDesk that we called Bollinger Bottom. You can design those yourself using QuantDesk, but here we're going to look at methods that we can do it automatically. Now it's a challenging process. So let's suppose you were going to build your own event definition or nugget using 5 factors. Well, keep in mind we've got 350 factors in QuantDesk, so there is a huge number of potential nuggets you might design. So it's a very difficult process of finding which ones might work. And if we could evaluate 1,000 of these each second, which would be quite challenging computationally, it would take more than 100 years to check every one. So it's essentially a problem that's not really feasible by brute force. And in artificial intelligence, we call this a search problem. And there are many different approaches to solving these sorts of search problems. And genetic algorithms is one of them, and it's one that we've seen that works really well. So what is a genetic algorithm? We'll get to that in just a moment. But let's think for a minute about ways that we might solve this problem. One is brute force. We've kind of discounted that already. You can't, if you've got 166 years, yes, but the market will have changed significantly by the time you get there. Another is human intuition. So that nugget I showed you a few moments ago was developed using human intuition. There are 2 other methods certainly there's even more, but 2 that come from AI are sequential feature selection, which we have tried, but we at Lucena Research, but we've also discovered that heuristic search using genetic algorithms works really, really nice, and so that's what I'm gonna dig into now. Okay, so what is genetic algorithms? Well, as you might expect, it's something that's inspired from biology. And there are 3 key aspects of that biological inspiration that we draw upon for genetic algorithms. The first is we must have selection. So selection means that somehow we're able to choose the best of a certain population and allow them to go forward and influence the next generation. So in the case of genetic algorithms, you can think of sort of each individual in a population as a nugget or some solution to one of our problems. So instead of it being, live animals or whatever, it's a solution to a problem. So first thing, we have to have selection. Next, we need some way of combining individuals. So in nature, this occurs, through mating and sharing of genes. But specifically, there's two key activities going on there. One's called crossover, which is how the genes from one individual and another individual combine such that the offspring is some sort of mixture of the two. Another is mutation. So every now and then there's some sort of random switch thrown in there that causes something random to happen. Most often that's a negative aspect. It's not necessarily a good thing that happens, but then again, sometimes, rarely, mutation can cause a positive result. So we take inspiration from those three processes, and that's how we build a genetic algorithm. So when we want to apply a genetic algorithm to a search problem, for instance, this one of finding nuggets, we've got to do a few things. First thing, we have to define, what is the code? What does a gene look like? And I'll show you in a moment how we do that for discovering nuggets. Next, we have to define fitness. In other words, if we have two nuggets, how do we determine which one is better than the other? Next, we need some crossover method. So if we have, for instance, two good nuggets that we want to blend in some way, how does that crossover occur? And then finally, some way for mutation to arise. If we have those, we can take them together into algorithm that I sort of outlined below, and generate generation after generation of candidate organisms or nuggets that we might use for investing. So here's how we do it. We initially create a population of 50 nuggets randomly. Each one has a random set of factors. So we've got 50 individuals, each one with 3 random factors. Next, we evaluate the fitness of each one. And the fitness that we use here is essentially a Sharpe ratio. So we look at each event over the time period that we're training, and we look at every time an event occurs, stock and date, on average, what's the return and what's the standard deviation of return. So we divide the average return by the standard deviation. That gives us a kind of Sharpe ratio. Next, now that we've evaluated the fitness, we decide which individuals can influence the next generation. We do this reproductive cycle, which I'll show, and then repeat. We just do that over and over and over again through multiple generations until we reach some sort of stopping criteria. And I'll mention that in just a second. So just recapping, what is a nugget? It's in the examples I'm going to show you now, it's 3 factors and then their thresholds. So in each generation, each individual is going to be one of these nuggets with 3 factors. Now, suppose we have 2 of these nuggets, and parent 1 uses factors A, C, and E, and the other one uses B, C, and D. We've decided, okay, we're going to allow these 2 to reproduce. How are we going to combine them into essentially the child nugget? So the typical approach here is that you consider the definition of the organism to be a list of symbols. So in this case, A, C, and E for that parent, B, C, D for the other one. And you randomly select a point at which you take the genome from one of them and switch it to the genome for the other one. So let me show you what I mean by that. We, for instance, in this case, choose to take, so we've randomly selected a number between 0 and 3, essentially. And what that means is, in this case, this is the crossover point. So we take the essentially the genetic material from this parent from here to here, and then the genetic material from this one from there to there, and combine them together into the child. So this crossover point is chosen randomly. And as you can see, again, we take the first two factors from this parent and the last factor from that parent, and we get this resulting child, which is in some sense a blend of the two parents. That's a recombination or a crossover. We also have mutation, which means that occasionally we randomly select one of the factors to mutate, and we put a random factor in there. So that's crossover and mutation. So here's how it works all together for a large population and multiple generations. So first step is we randomly generate our initial population. So you can see here a number of nuggets with different random factors. Next, we score them. So we take our fitness function, remember, which is essentially a Sharpe ratio, and I'm indicating higher performance with a larger blue circle and lower performance with a smaller blue circle. We sort them, so we here have our best ones over to the left. And now it's time to decide which ones get to continue into the next generation. So something we do in our algorithm is we always allow the best two to continue on. Then we fill out the rest of the individuals for a particular generation by randomly selecting parents to be combined. Now the chance that any one particular individual at this generation will be selected is weighted by its fitness. So we're more likely to pick parents over here towards the left than ones over to the right. So in this case, these two were randomly selected, and that's the child, and so on, another set of parents, and eventually we fill out that whole new generation. So this new generation now presumably represents kind of an improved population because the higher performers were able to push their genes into the next generation. So again, we evaluate them, sort them, and again, the best two get to continue down into the next generation, and so on. We fill out that generation. We repeat this over and over and over again until after a while things stabilize and the offspring are just not getting any better. And after we see for several generations that the best nugget is not improving, we stop and say, okay, this best nugget is the outcome of this process. Typically, we run about at each generation we've got 50 individuals. Actually, I'm sorry, we use 64 now because of the number of processors on our machine. It fits better. But we typically go through about 300 generations before finally it stabilizes and we choose the best nugget to go forward. Here's an example of one of the nuggets we've discovered in this way. We've actually discovered, we've got hundreds of nuggets actually, but let me show you this one. This one is based purely on technical factors. So this is its definition, which is an Arun up. The first factor is Arun up. Second factor is Arun down. Last one is days since death cross, and you can see the thresholds defined over here as well. What does that look like when we run the study? Here's the result. This is the date the event is checked for. That the factors Arun up and Arun down, both having to be satisfied, cause this sort of odd pattern here just before the event. But you can see over 10 days, on average, we see a return of about 1.88%, but there's a very very strong standard deviation there. But anyways, just recapping, each day in history, we check for each stock in our universe, are these criteria met? If so, we buy the stock, and this is the result of what happens on average. Now we can turn that into a back test, and this is one of the great features of QuantDesk. And so this is a back test going back 5 years, and this particular Nuggets performance is illustrated here with the orange line, and our benchmark S&P 500 with the blue line, and you can see at any one point in time, what the net return is, and so on. Also down here, as part of our back tester, you can see at any one point in time with this green line how many positions it's in. So you can see it's in 40 or 50 positions. This red line on the very bottom is showing on each particular day how many events triggered. We have a somewhat deeper full report here. You can see for each year relative performance of the strategy. So for instance, it performed extremely well in 2013. It hasn't performed quite as well as the market in 2014. But our backtest provides, for instance, what leverage you're looking at in any particular day, many statistics such as Sharpe ratio and volatility, and then we even show for each day in history what the transactions were, how much we would have allocated, and so on. So that's one nugget that we've created. Like I said, we've got many more, and for the next presentation, we're going to show you some more of those nuggets that were created by genetic algorithms. But I think even more interestingly, we're going to show how we can sort of direct our genetic algorithm to find specific sorts of nuggets. For instance, if you've got a preference for momentum-based strategies, we're building a strategy based on hundreds of nuggets that all use some variation of a momentum strategy, and they're combined into a complete strategy. How do we combine them? That's something else we'll talk about next time, and it's a very interesting and challenging problem. But in particular, we've been looking at ways to allow essentially each nugget to vote on which stocks ought to be longed or shorted. But you can build strategies such as, like I said, momentum-based, small cap focused, fundamental-based, any number of sort of focused strategies. We can build a set of genetic algorithm based nuggets to make that work. Let me now pause for a moment and take questions. Be glad to take your questions now, and then after we take a few questions, we will we'll wrap up and be glad to we're going to invite all of you back to the next half of this webinar next week. Okay, I'll just start with the last question. How do you choose? So, repeating a question from Michael, how do you choose the amount to invest at each event? Does it differ depending on the stock, or are they all the same? So there's a number of different approaches to that. One is that you might weight the allocation depending on how successful the stock has been with a particular event definition. That's something we're looking at. That's something we're looking at right now. Another approach that we're exploring is each. So if your event seems to work best, say for a 5 or let's say 10-day cycle, what you can do is each day get in the handful of best stocks according to the voting from the system and rotate out your old positions. So each day you pick the best new ones and you rotate out the old ones that have more or less expired. We're finding that to be a good way to efficiently allocate and sort of be sure that you're always 100% invested. Okay, question from Hector. Are event-based studies applicable to bonds also? Yes, certainly. In fact, any asset for which we have historical prices, we can investigate for events like this, and we definitely look at fixed income type assets as well as stocks. One of the reasons that we focus initially on stocks, of course, is because there's so much data available, and it's a rich environment for searching for events like this. But certainly the approach can be applied to fixed income as well. Next question from Andrew. Do you randomly assign values to the thresholds for each factor? So the answer to that is we're exploring the best way to do that. The method that we have been using is given a set of 3 factors, we quickly test a number of combinations of thresholds for all 3 factors to find essentially the combination that works best. So for, say, one nugget that has factors A, B, C, and another nugget that has factors A, B, D, the thresholds for A and B wouldn't necessarily be the same in both cases. We find the thresholds that work best for the combination of factors. Now that takes a lot of computation time to find the best combination. So we're also looking at allowing that to be something that essentially evolves through the use of the genetic algorithm. But for now, we just find the best for that combination of factors. Question from Fernando. Have you tested GAs that adjust the thresholds? Okay, so that's essentially the same question. Like I said, at present, for the combination of factors, we find the best set of thresholds that optimizes that combination of factors. Do you have examples of how event-based strategies work during a downturn in the market? Yes, we do, and in fact, in the same way that we can discover factors for long positions, we can also discover factors for short positions. Okay, let me see if we got any more new questions. Are there exit events out of the positions outside of the mentioned rotation? Yes. So once we have an event defined, we often explore it in a little bit more detail by looking at different exit conditions. So the baseline is okay. We've seen in our event study that profit is maximized after, say, 5 days. So our baseline is okay. We enter and then we always exit after 5 days. But we can also put in stop gain and stop loss triggers there to exit early, and we explore those parameters to optimize for any particular event what works best. So it's definitely the case that the best strategy is a combination of A, what is the event definition, and then B, how do you trade it? So you need to consider both aspects of that. I'll do 2 more questions. Here's one from Michael. Where do you get all this data from? So we have a number of data providers. I'll need to keep that confidential, but they are companies you've heard of that provide data to hedge funds and wealth managers. They're the regular sorts of companies there. What we do additionally, in addition to the fundamental and price data that we have, is we generate about 300 of our own technical factors, things like Bollinger Bands, MACD, Death Cross, Golden Cross, and so on. Like I said, we've got over 350 of those, which are a combination of fundamental factors, technical factors, market-wide factors, macroeconomic factors, just a whole slew of different things that can be considered. Have you tried to use multiple nuggets for a diversified pool strategy? Yes. In fact, that's our focus right now. We believe that having multiple nuggets that are using different factors can provide a much more robust result. And the key question there is, if you have multiple nuggets, how do you appropriately combine them? And we're seeing that voting is a promising way of doing this. I'm not saying we won't find other ways, but it seems that if you have a diverse set of nuggets and each nugget can cast a vote for multiple stocks on each day, and then you look at where most of the votes land, that's suggesting, say one particular stock has votes from 10 different nuggets. That means essentially there's potentially 10 different reasons that that stock might go up. So we think overall that's going to provide a more robust approach. So let me close now and say thanks very much for your participation, and look for the invitation for next week, where we will revisit this issue of how do you combine multiple nuggets together into an effective strategy. And we'll talk a little bit about specific additional example nuggets that we've discovered. So thanks very much for your participation, and look forward to seeing you next week. Thanks so much.